The peso problem, what's now commonly called a black swan, is this idea found by Friedman. And Milton Friedman noted that the peso dollar FX rate was fixed for 20 years, from 54 to 76. And interest rates were always higher in the Mexican peso. So it seemed like it was arbitrage, right? You could always make more money. Well, in 76, the peso was floated and it lost 45%. Okay, boom, one day you're done. And then in 82, they did it again. They lost 82%. Boom. So let's just say these are little lines representing your returns, and you make boom, 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 and then boom, big loss. So the average of these might be 0. So the small probability of a big loss explains the interest rate premium for the peso. And a lot of times all you sample is this data without the black swan event, the big loss. Now, Robert Barrow, he looked at actual numbers of these type of catastrophes in markets worldwide and argued that the U.S., we've had one big loss in the Great Depression where GDP went down about 30%, but most countries have had a couple of those. And of course, the losers in the war had bigger losses and things like that. So he thinks that if you make an adjustment for the fact that for the average probability of a catastrophe as measured empirically, that would lower our equity risk premium by about 300 basis points. And so that he estimates is about a 2% chance of a 15 to 45% decline in GDP. That's the worldwide experience in the 20th century. Then there's survivorship bias. The USA is primary data point in the world. If you look at a world value weighted index, we're going to dominate that. But coincidentally, the USA is 2-0 in world wars, and the Communist Party has never been popular here, and that's had a very good result on our stock market returns. So Brown, Getzman, and Ross found that, well, all these countries like Czechoslovakia, Hungary, Poland, Russia, China, they all zeroed out. Their equities went to 0 at one point during World War II, or when the communists took over. So that's, why isn't that included in the databases? And Jorin and Getzman found that the U.S. real return is 350 basis points above the median for the 39 countries in the 20th century. So the U.S. survivorship bias adds about 350 basis points to the biases, the expected return by 350 basis points, simply because the U.S. was just kick butt in world wars and didn't like commies. And going forward, there's no promise that we're going to be that lucky. Then there's taxes. This is interesting. I made a lot of money in '87 and on the stock market, and taxes just killed me. And you have to take into account, let's just say you make 10% stock return. Well, that's about a 6% post-tax when you have a 40% tax rate, right? So you're really interested in your after-tax returns, not your pre-tax returns. Gannon and Bloom applied this to the S&P 500, assuming a 20% turnover in your stocks. So the 20% would generate this capital gains realization from 61 to 2005. And they used actual capital gains tax rates as they existed in these years, and the average top-tier tax rates for dividends. So if you were Mr. Moneybags and you were receiving income, took advantage, they accounted for the difference between the personal tax rate that would be applied to your dividends and the capital gains tax rate. The capital gains tax rate has averaged 26% over that period, and the top tax rate is 49% average over that period, and that includes about a 6% state tax average. So these are all averages. But if you applied that to the S&P stock return, it takes a 10.62% pre-tax return and turns it into a 6.72% post-tax return, which is just marginally better than the long-term municipal bond buyer index return. And this is the index return on the tax-free muni bonds in the United States. Municipal bonds are tax-free. So it turns a 5% premium into, about a 50 basis point premium over this muni bond index, just by taking into account taxes. That's a huge reduction right there. That's like another 400 basis points. So let's sum all these up. A lot of people have taken into account a couple of these. And so when FAMA had a paper, FAMA in French, they came out and they said, hey, this post-World War II reduction in equity premium, it's important. It explains much of the equity risk premium. It's 3%. Okay. And then Ilya Daichev comes out and says, you know, adverse market timing, that's really important. You know, it's 2 to 3, 4%. And then somebody else like Barrow come out and say, well, we have to account for peso problems to explain. So they're using these to cut the equity risk premium in half. But if you just add them all up, you get this huge number, 17%. So, like the OJ trial, you can throw out 80% of the evidence, and OJ is still guilty. You can throw out 80% of these costs, and you still take the conventional 3.5% equity premium that most academics assume, and you get to zero. For your average investor, not the sophisticated, patient investor with low marginal tax rates, but your average investor in the 20th century, it seems likely that they probably had a 0% return on their equity investment compared to the risk-free rate. Sad, but true.